Hello, everybody. Is the U.S. service sector the last shoe to drop in this economy? And are we finally going to start to see this most forecasted recession ever that everybody has been talking about for a year? Or is everybody still wrong? Welcome to Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. We're going to get some important economic data as we come back from the holiday for this rest of an abridged week amid thin liquidity. That key data is going to tell us whether, in fact, the last shoe to drop, the last domino in the recession story that we've been watching here is finally ready to drop. And that, of course, will be a critical question really all around markets. So first, what we're going to do is figure out why this is so important, why this is so formative for everything that we're looking at for stocks, for currencies, for bonds, for really the whole universe of financial assets, and then see where things stand and what we're actually expecting to see and how might the outcome influence all of these asset classes. Let's begin with just an assessment of where things currently sit. So looking at the breakdown here, the problem is, as ever, that inflation expectations seem to have stopped falling. So we can see here in the orange is the 1-year USD inflation swap. That's a measure of the price to inflation outlook over 1 year. The yellow bars are the 2-year break-even. So that's an expectation now from the bond market for where inflation is going to be in 2 years' time. And 2 months lagged behind them are the headline numbers, US CPI, US PCE. At this point, we've had the latest updates on both of them. PCE was last to come on Friday last week. So we can really see a complete picture. And the upshot is, the market does seem to think the Fed is going to get close to their target in about 2 years' time, but still not quite there. 2.1% on the 2-year break-even and 2.5% on the inflation swap to tell us that we're going to approach target. Most of the disinflation is going to happen over the next 12 months. But what you don't see is that that disinflation continuing to develop. So if these expectations are indeed leading headline numbers by about, let's call it between 2 and 3 months, just to be fair to the likely uncertainty around all of this, things never really work exactly perfect, then this is a bit of an issue. Because what it implies is that perhaps there is an entrenching of expectations that sits this inflation number north of where the Fed wants to be in the time that it has to get to where it wants to go. And that, of course, is a problem for policy officials. They don't want to be in a situation where we almost get to target, and that's the expectation that gets baked into the outlook now, which then undermines further progress toward that target because people start to behave as though this is where inflation is going and it's not going to improve further. The Fed would much rather these numbers be under 2 and then have to do some degree of easing to bring them back up. That would give them some wiggle room. At this point, we're just barely priced for near perfection. And if there's any kind of outturn whatsoever that proves to be inflationary, then we're off target. So this is the crux of the issue now facing the Fed, and the reason why the messaging from policy officials has been so hawkish, including from the June FOMC minutes published today. What is that stickiness attributed to? Here's the breakdown of CPI. We've looked at this chart before, and we'll unpick each layer of this briefly so we can get a sense. Let's begin with the goods side. The goods side was obviously a major part of inflation going back to the beginning of 2022. You can see that orange wedge is quite big at that point. You can see it's been whittled down to next to nothing. And that is in part central bank tightening efforts. You can see here that rising rates at the Fed have lined up with a slowdown in global trade volumes. So to increase the borrowing cost of dollars, the quintessential global commercial unit of exchange, has had the desired dampening effect on economic activity. The dark line there is a cumulative global turnover, both exports and imports together. And what you're seeing there is indeed you put a higher hurdle rate on economic activity, you make it more expensive to finance that economic activity, the economic activity starts to come down, as one might expect. So that's part of undermining goods demand in a disinflationary way. And you can see it's having that effect. So the blue bars here are that same dark blue line that you see. And the line overlay, obviously, is US CPI. You can see that with the deceleration in activity on the trade side of things, with that undercutting of goods demand, CPI is coming down. That's part of it. The other part of it is what's going on with the mending of supply chains, where you can see lots of work has clearly been done to address the issue. The Baltic Dry Index, which is a measure of global seaborne shipping costs, that's back down to pre-pandemic levels. The cost to moving goods around the U.S. supply chain, both intermediate goods, so moving them from the place where some finishing work is going to get done to another and back and forth, and then the final goods component, so once something is actually finished, getting it shipped to the place where it's going to get sold. You can see the growth rates in those have come down aggressively. In the case of intermediate goods, they're now shrinking. In the case of final goods, they're not quite in negative territory, but they're right around levels that were the prevalent sort of normal average pace for this before the pandemic, before things really took off. So ostensibly, supply chains are no longer a major complicating factor for goods inflation. And so the upshot is that the orange wedge here has been squeezed down to very little. Energy, of course, is the other big story here. Energy at this point, you can see the little bit of yellow on the bottom there under the zero line. It is now a disinflationary force. And you might surmise why. If we look at how much overall commodities are down year on year to start July here, down 7.9%. Those things that are exported out of Russia are clearly down by a long mile more. Wheat down almost 24, crude oil down to 21, nat gas down 63.5%. All of which is to say, energy is clearly a lot lower than what you're seeing for commodities in general. And we've argued here, I've certainly been of the view that this is Russia attempting to retain market share, that Russia is undercutting other producers of these things that it is a leading exporter over, one of the leading exporters of, and those things that still are able to pass through with relatively little barrier, because there's been carve-outs in the sanctions for these things. They want to make sure that they keep money coming in They do need to finance war, after all. And they need to perhaps make sure that while they're behind sanctions on almost all other things that they might do business in, that in these critical areas, they don't lose market share to the competition. Because these are the last little bits of hard currency supply that they're able to get selling these things. So Russia has been out here trying really to compete on price in a way that retains for them as much of the market as they can keep. And that's been a significant pull on energy. Of course, slowing global economic activity, as we've just seen it, is a big part of the story as well. In this kind of an environment, as we just saw, reduced economic activity means a reduced pull on energy. And so, not surprising to see that be a disinflationary force. Food inflation is something of a more consistent wedge here. You can see it's been holding up pretty well, but that seems to be mostly episodic. So if you look here at the difference between energy and soft commodities, this is the likes of, let's say, coffee, sugar, cotton. So things that grow in the ground, things that are planted. You can see here that there's been a meaningful difference. Energy, of course, down, softs holding up much, much better. And that's part of this food inflation story. And seems to really come down to one thing in particular. There is that softs index in the blue, and you can see it's really starting, even more so than before, to cling to sugar. Now, with sugar, we had a bit of a special case situation. There was something of a deficit fear in the market because India, the fifth largest producer, decided they were going to cap exports, fearing there would be a shortage domestically. And that was a real big lift, seemingly, on soft commodities more generally. Sugar, of course, a critical input into all kinds of things. We start with the vast universe of processed foods alone as just a tremendous pull on sugar. And we see a whole universe of other things, clearly. Sugar is a staple, to say the least. So that seems to have had a very significant knock-on effect on soft commodities and on food prices more generally. At this point, that might be starting to recede because just as we've had these supply issues in India, there's been oversupply because of a particularly good crop and a particularly fruitful season in Brazil, which is an even larger supplier than India. So you now have a situation where maybe the food component of the inflation picture here is going to start to go away, or at least to be meaningfully reduced in the coming months. Even so, that food component is relatively small when you compare it to the service sector component, excluding food, excluding energy. That's by far the biggest thing and the reason why the Fed will not stop talking about it. We just heard it again last week from Jay Powell, the Fed chair, at the ECB Forum on Central Banking. That was the fourth speaking engagement in 3 weeks. First, there was, of course, the policy announcement mid-June with the press conference. Then there was, on the subsequent week, back-to-back testimonies to the Congress, first the House, then the Senate, and then this ECB forum last week. And the Fed chair has been pretty consistently banging on about this service sector being something that needs to be addressed that is the source of the issues that the Fed faces and the key to getting these inflation expectations to come back down, or at least to resume declining. Now, of course, the biggest issue there is employment. And you can see the orange bar there is the expectation for the latest in this story. Expectations looking at the JOLTS job openings number that's due to come out tomorrow. It's not out yet, which is why that's an expected bar, not a realized one. But you can see there that at the start of COVID, there is significant oversupply of labor relative to demand. So those blue bars are very tall and inflation is very low. As they start to narrow in with the reopening of the economy, people coming out of lockdown, people returning to work, you can see that inflation starts to come up. And what we see really as a baseline state of affairs from the second half of 2021 through now is a vast undersupply of labor, a vast deficit. And part of that is the impact of stimulus. Part of that is demographic. The retirement of baby boomers was, of course, something that was creating a slight deficit already going into COVID. You can see that right here. But this is clearly something much more dramatic. And as it's come off the peak somewhat, you can see inflation has come down a bit. But of course, that last mile from around 4 to around 2 seems like it needs to deal with this. Because if supply chains are mended, if everything else has been largely addressed, this is really the last bit. And that's the service sector. Because most people are employed in the service sector in the U.S., between 75 and 80%. So getting this mismatch addressed really becomes how the Fed is going to get to where it's going. Now, you couldn't address this mismatch with an increase in supply, ostensibly, because there doesn't seem to be an appetite for a massive immigration reform to bring tons of external labor. There doesn't seem to be a way to clone a vast army of workers domestically, nor to spin up AI to really support some sort of an efficiency offset at scale to resolve this issue. And so whatever solution probably has to come from the demand side, lowering demand relative to the available supply of labor so that inflation is squeezed out here and thereby out of the service sector. With this in mind, we are laser focused here on the ISM service sector report, which comes over the course of this next day. Now we get to the brass tacks of what's ahead. Earlier this week, the manufacturing component came out. You can see that line extends a little bit further than does the services line in orange. And what you see there is deepening turmoil. At this point, the manufacturing sector is shrinking at the fastest rate since early in the pandemic. So you can see right here, at 46, we are under this 50 line. 50 is in the logic of both ISM and PMI numbers. The neutral level, here you have neither growth nor contraction. Under 50 is contraction. Over 50 is expansion. The further you go above, the faster the expansion. The further you go below, the faster the contraction. It's called the diffusion index. And so what you have here then at 46 is the most dire conditions for manufacturing that you've seen since early 2020 at the onset of COVID. And this makes sense. We just talked about the slowdown in global goods demand and overall economic activity. So it makes sense that manufacturing here is as hampered as it is. But the main story has been that services has been more resilient, that indeed the expectations here are that service sector activity growth is actually going to perk up a little bit, that we got almost down to neutral in May, and that these June numbers are going to actually see a bit of a rebound. Now, here's what the manufacturing breakdown looked like. So you can see there's the decline to 46 on the main index. That's the yellow bars there. Look at the breakdown in overall numbers relative to the components, and you see that employment shrank at a faster rate for the manufacturing sector. The price component, likewise. In fact, there's now a fairly brisk contraction, and that's part of the goods inflation story going away. New orders are still in contractionary territory, a bit less so. So the pace of contraction in new orders a little bit slower than it was in the prior month, but you can see there's something of a range there really since the end of last year. And so not a whole lot seemingly going on. The story that we would get from a competing set of PMIs, this is from S&P Global, would suggest that the service sector is getting ready to follow the rollover in manufacturing. So here you can see very much the same story in terms of the deepening spread between what's happening in manufacturing and what's happening in services. And you can see services, at least as far as S&P Global is signaling, start to roll over, start to pull the composite index along after what's going on in the manufacturing side of things. If that's what follows when we look at the service sector ISM survey, we might see the Fed start to make some headway, and that might feed expectations. However, if we look at how U.S. economic data has been performing relative to forecasts, well, then we get into a space where it seems like the path has been towards surprises on the upside. In fact, we are at this point doing about as well on U.S. economic data flow relative to forecasts as we did back in February, where there was a lot of tightening that was baked in response. And of course, the knock-on effects of all of that tightening and the yields march that resulted was the SVB-led banking crisis. There's not really evidence that something like that is on the cusp of occurring again, at least at the moment. But there is certainly the sense that U.S. economic data is doing better compared to what economists think it should be doing, and that this creates upside risk for the largest component of the economy, the service sector. Already, we can see the markets are responding both to a U.S. economy that's been doing better, looking at that data, and to Fed rhetoric that has been quite hawkish. We can see that we've fully erased all the easing that was expected for the back half of this year. The dark line there is July. The red is December. So this is essentially policy as it is baked into Fed funds futures, reflecting expectations for the back half of this year. You can see at this point rates in December expected to be a bit higher than July. So not only are there no cuts here, we might be looking at almost a full hike at this point. Not quite yet. A full hike would be 25 basis points. We're not quite there yet. But the market clearly seems to think that there is a level of restriction that's more likely at this point. In fact, if we look at baked-in expectations, we can see there is 85% probability of a hike for July already baked in, 21 basis points already there out of the 25. You can see that's fully baked in comes September. There's already a 27 basis point implied rate delta there as relative to current. We flirt with a little bit more in October. You can see 33 basis points in, so there's some probability of a second hike, but a 32% chance that we're going to get a second hike by then. You can see then things begin to recede. So if you look at right here, there's the full one hike baked in by September. So it's going to happen either in July, you can see here, or September, but between those two meetings, it's fully baked in. Then 32% chance for a second hike. 1.32 means one is in, and about 32% of a second one is in. So a slight chance that there's going to be more. You can see those chances start to fade by December, and cut possibilities start to emerge. You can see really we get to unchanged, so giving away that hike that we are talking about here for July, September, that hike is given away come May, it looks like. Slight possibility that it might get done here, 26% chance of a cut, 39% chance of a cut in March. It starts getting better than even in May. So 53% chance of a cut, slightly better than even in May. So it looks like at least the initial hike that we're going to see in the back half of this year by that point is gone. And then you start to see the cuts really build. So first one fully baked in by July, second one by September, third one looks like by November, December of next year. So it would appear that at this point, fairly sanguine sort of things afoot here. And the question then will be, which way does this ISM number go? If the biggest part of the economy ends up looking more like what we're seeing here, well, that might beckon a still more aggressive Fed path forward. The Fed has been saying that they don't envision any cuts next year, which is obviously different from what the markets are talking about. We just saw they were looking for between 2 and 3 at least next year, maybe even 4. If these numbers are going to look like what this surprise index is telling us, Fed might need to do more if it wants to get inflation expectations coming down, because it needs to turn the screws on the service sector much more significantly. If, on the other hand, what we get looks more like this, and we start to see the deceleration being flagged by S&P really show up in the ISM numbers also, and if what we're seeing in the manufacturing side really starts to catch up, and this surprises lower, it's an interesting thing to ponder what the reaction might be. The Fed is certainly not going to get off its square vis-a-vis hawkish rhetoric. They've just spent all kinds of capital, political capital, credibility capital, to make the point that they would like to be more restrictive, more hawkish. If we start to see evidence that the economy is really starting to buckle finally, because the service ISM number ends up looking weaker than anticipated, the situation is going to start look like the Fed is geared up to hike at a time when, looking out a few quarters, recession risk looms larger than even the Fed is anticipating. They've told us that they're perfectly okay with a mild recession. We just saw that again in the FOMC minutes today. But what if things look more dire than what's currently baked in? Well, then you get something of the worst of all worlds: a hawkish Fed, more rate hikes, and growth that's already being choked off. And that seems like a very adverse scenario for stocks and growth-geared commodities, as well as the sympathetic currencies like the Australian dollar or the Canadian dollar. It probably is then supportive for the US dollar as well. In fact, if you got a positive surprise of substance, that's probably supportive for the US dollar too, in that it boosts yields, probably negative for the risk complex, albeit to less of an extent also. The real difference maker here might be yields and the yen. And to that extent, perhaps gold as well. If the number is better than expected, you might expect gold and the yen to do poorly and yields to come down a bit, or rather to come up a little bit. If the number does poorly and is weak, and it's recession risk that we're concerned about, yields might come in which case you might get a better view on gold, a better view on yen, and that might be the difference maker in a world where stocks look vulnerable absent a real as expected kind of outcome, and the dollar looks well supported. Again, absent a right on the money kind of outcome. And that is Macro Money for today. Thanks very much for joining. We'll be back tomorrow to unpack all of this and also to set the stage for U.S. jobs data coming up at the end of the week. That, of course, as ever, the big kahuna of economic releases due Friday. Macro Money here happens Monday through Thursday on non-holiday normal weeks, right after overtime with Chris Vecchio, where he and I break down the day's events and try to make sense of them and see what might be coming next. I'm also on with Chris for Futures Power Hour on Fridays, and then on with Tom and Tony for First Call on Sundays. Outside of those, I'm opining on Twitter at Ilya Spivak and writing for tastylive.com. Thanks very much for joining, as ever, everybody. Good luck out there. See you tomorrow.